Welcome to Topic 10, Capital Investment. In this short video, we're going to be looking at the nature and scope of investment decisions and then going through a number of different methods by which we can ascertain whether or not a project should be considered. We're going to look at the accounting rate of return, we're going to look at the payback period, we're going to look at net present values, and within each of them, we're going to look at applying them using a fairly simple example, as well as some of the practical issues in making those particular decisions. So some of the benefits and drawbacks of each of those particular methods. So investment decisions, these often involve large amounts of resources. And because they involve large amounts of resources, you want to have some level of consideration about how you do it. You don't just simply go, I'm going to throw money at doing that particular thing. You should hopefully go through some level of process to determine whether or not you should make that investment. They are going to involve risk and uncertainty, and these are just things we cannot get away from. And these are important to consider as we go through the practical example and how this sort of bears out. They can, not always, but they can span long periods of time. So you may have your capital tied up for significant periods. There may be a large cash outlay to begin with, and those returns are received over a long period of time. So again, it's important to do a reasonable level of analysis before you start, just to make sure that you're on the right track. Because they have this large cash outlay and because the returns are received over a long period of time, they can often be difficult to reverse or to get out of. So again, it is useful to do your homework at the beginning. And they're going to be made on the basis of best available data. It's not going to be perfect. Nothing in this life is. It's also going to be based on the data which is available to hand. Doesn't know necessarily what's going to happen in the future. So risk and uncertainty. So beginning with risk. Risk in financial terms is defined as a measurable variation in outcomes, and the idea behind it is it can be measured with some degree of confidence. That being said, if you've read or you've heard of Nassim Nicholas Taleb, and you've come across his book, The Black Swan, there's obviously an element of how much can we really understand risk and understand what sort of likely outcomes will be. And you can only just look at what's happened over the last few months with the pandemic to understand that some things which we thought the future held with some degree of confidence doesn't necessarily hold. Uncertainty is this unmeasurable variable in outcomes. Now again, for the purposes of this particular topic, we're going to just hold these ideas as they are, but just be aware that these things are a little bit more fluid than what we're talking about here. So the nature and scope of investment decisions, you should be trying to identify all current available investment alternatives. Now that word all there, I don't know if any one of us can identify all potential investment alternatives because there are literally thousands of these things. But within the scope of the type of investments that you're interested in, and obviously there is going to be a sort of natural limit about what we can choose. But within that, identify those alternatives that you're happy with, and then select a decision support tool and set some sort of decision rule. So if it's net present value, it might be anything which is positive. And we'll get to net present value decisions in a bit. If it's a payback period, it could be the shortest payback period. Again, have some sort of idea of how you're going to analyze the different alternatives and then come up with a rule that helps you make decisions once you've done that. Then it's going out and collecting all the data that you can. Well, not that you can obviously collect data which is not necessarily relevant, but all the necessary data to help you make that particular decision. And again, it may not be cost effective to collect all the data that's available. You may have to run off just the data that you can get your hands on. It depends on the importance of the decision, depends on the margins that you're talking about. Then it's analyzing the data. We're going to use three fairly high-level decision rules or mechanisms here. We sort of attach decision rules, but by no means are these the only way you can go about these. Then some some sort of interpretation of the results in relation to the decision rule. So it could be that if you're calculating net present value, what is the number that you end up with and how does that relate to the decision rule? Should you accept the decision or should you accept the project or not? And then finally, as I've alluded to, you make the decision. You pull the trigger, you put your money on the table and you go for it, or you walk away. Because there should always be that option to walk away from an investment decision. If it's not stacking up, don't put your money down. So the first of these rules, and with each of these we're going to use a fairly basic example just to provide some color to what we're doing, because it's obviously always good to try to do these things with examples in mind. So for the accounting rate of return, the accounting rate of return is calculated as the average profit over the average investment. Potential decision rules for the accounting rate of return is just to accept the investment with the highest accounting rate of return. So whatever gives you the biggest one, that's the one you go. Or it could be you have a floor to it, so that as long as you hit a required rate of return, whatever that level happens to be, anything below that you just don't worry about. Anything above it, that's where you start to consider it, and depends on your available resources to deploy. We do need to understand what profit is and what average investment is, so let's go and have a look at an example to do this. So I've gone up and just set a framework. Now this is just a framework that I put together. It doesn't have to be exactly the way that you do it. But it's just got all the elements here that we're going to need for not only the accounting rate of return, but for the payback and net present value. So we've got year zero. That's just to denote the initial investment cash flow, which will come up here. We've got years 1, 2, 3, 4, and we're assuming the cash flows happen at the end of, or the profit cash flows, whatever they happen at the end of the year. That's not strictly true, but just for simplicity here, we're going to do that. So this particular investment lasts for 4 years, and the opening investment is 120. Now, whether it's 120 million, 120,000, it's pretty immaterial at this point. It finishes with 60. So what this means is they're buying a particular piece of machinery. It's worth 120 million to start with, and it is going to be able to be sold for 60 million at the end. So there is going to be some closing cash flow from it. So we're going to put these in here. So we've got an opening cash flow, or a starting investment cash flow at time 0 of negative 120, and at time 4 it is 60. The operating cash flows each year are 30, 60, 50, and 40. So this is all assumed information. So after, doing all the work and various costs, costs involved and payments to people and money earned, they end up with 30 million or 30,000 in year 1, 60 in year 2, 50 in year 3, and 40 in year 4. The other piece of information we have is a discount rate of 10%. Not relevant here, but will be relevant later on. The average investment is just the average of the opening and closing. So we've got 90,000. The depreciable amount is relevant here because what we have so far are cash flows, but we actually need profit because it's the accounting rate of return. So the total amount which is going to be depreciated over the 4-year life of this asset is the difference between the opening amount of the asset and whatever it ends with, the 60. So it gives you 60,000. So that means the annual depreciation is the 60,000 divided by 4. So we have 15,000 a year. So depreciation is negative 15,000. That means profit is so that means that profit is 15,000 in year 1, 45,000 in year 2, 35,000 in year 3, and 25,000 in year 4 to give you an average. I'll do that over here. I can spell it correctly. Equals average of 30,000. We have the average investment. Average invest is 90,000. And so the accounting rate of return is just 30 divided by 90 gives you 33.33%. So we have now calculated an accounting rate of return of 33.33. The advantages of this is it's relatively simple to calculate, it's relatively easy to understand, and it is consistent with an ROA measure. So you saw that once you've got the cash flows, once you've worked out your depreciation expense, and you know your opening and closing investment cash flows, you can actually work it out fairly simply. There is a problem with it. I mean, there are problems. Like with anything in life, there's some advantages and some disadvantages. It ignores the time value of money. So we're taking that any cash flows in time 4 are the equivalent of cash flows in time 0, and that's not going to be the case. How much of an issue it is going to be dependent on the discount rate involved, but it does ignore it here. The importance of cash is ignored to some degree because we've included depreciation in here, because you're calculating out an accounting profit, not just worried about cash flows. And that leads into that third point, which is profits and costs can be measured in different ways. How we define something from a profit point of view and the revenues and costs in relation to it, we know there's some level of subjectivity in that. And often it's nice to look at just the cash flow effects. So there are some good sides to it, but there are also some concerns, mainly around the use of non-cash items, as well as the lack of time value of money. Moving to the next one, we have the payback period. And the payback period is a period of time necessary to recoup the initial outlay with net cash inflows. A potential decision rule for this could be a maximum period of time that beyond that, if it takes longer than that, they're not worried, they're not wanting to invest in because it just takes too long. And part of the reason for that is the longer the payback period, the greater the risk, because the longer it takes to recoup, the more likely something could go wrong in that time frame and you just don't get the opportunity to recoup it. So let's look at that in relation to the example we just looked at. So we have here, and we're just going to worry about cash flows. I'm just going to leave these in here for the moment, and I'll add these to the end. So we have net cash flow, and the net cash flow to start with is, so net cash flow in time 0 is negative 120. It's the 30, the 60, the 50, and then 100 because we're adding in both the realization of selling off of the asset and whatever the final kind of year's worth of cash flows are. And what we want is the cumulative cash flows. And what we see here is it's negative in time 0, which makes sense because that's when you've made the investment. It's negative 90, negative 30, and it flips. So we see a sign change between year 2 and year 3. So it takes about 2.5, little more than 2.5 years for that to happen. And so the payback period here would be about 2 years, 6 months, 2 years, 7 months, there or thereabouts. And that would be what you'd use to help make your decision. Whether that's good or that's bad would be dependent on the decision rule that you have set for this particular project. The advantages, that was super simple to calculate, really easy to understand. So you know it's going to take about 2 and a bit years to recoup your initial investment. It incorporates this crude awareness of risk based on sort of time it takes to recoup your investment. And it does use cash flow. So it ignores kind of accounting numbers. It does, even though we're talking about time periods, it does actually ignore the time value of money because it still equates $1 received in 2 years or $1 received in 4 years as the same as $1 received today. It also ignores everything after the payback period. All you're interested in is just climbing that mountain to where you want to get to, not how much further it goes. So you could have something that hockey sticks up, that goes up in a really sharp way, but has a slightly slower start. That is going to look worse than what we just had here. So you could well see less profitable short-term investments getting approved. And finally, net present value. So net present value specifically recognizes that $1 today is worth more than $1 in the future. So the calculation involved, so this is incorporating this time value of money element, is the cash flow at time 1. So we have all the details here. So cash flow at time 1 is divided by 1 plus the discount rate. The cash flow at time 2 is divided by 1 plus the discount rate squared. And so on and so on and so on and so on. So the cash flow at time n, whatever that period n happens to be, is divided by 1 plus r to the power of n. These are all the cash inflows during the period, during the future, and you take away whatever investment you made to start with. The factors involved in working out the discount rate, so the R, things like inflation and risk and opportunity costs are going to play a role in this. Coming up with a discount rate is not something that we'll be looking at in this particular subject. Obviously, it's going to be an important part of working out the viability of a project, and there are ways to do it, but it's outside the scope of what we're going to be doing here. Decision rule for net present value is to invest in projects that have a positive net present value. That means you are going to be better off investing in it than not. So let's have a look at this in practice. So there's a couple of different ways to calculate net present value. So I'm going to show you two different ways here. So the first is to work out the present value of each of these cash flow items. So the present value is the cash flow. So we're going to be worried about these net cash flows, is the cash flow divided by 1 plus the discount rate to the power of however many periods it is. So for T0 cash flows, it'll be to the power of 0, which gives us 120. And because I've got this set up, I can just drag this down and I'll show the decimal places. So 120, I'll also highlight these because we're comparing these two. That's a little too bright. 120,000 in T0 is equivalent to 120,000. 30,000 in 1 year is the equivalent of having $27,270 in time 1 if you have a rate of 10%. And the reason for it is, imagine you have that number. So imagine you have this to invest, and imagine you're going to get 10% return on it. How much profit you'll make on it, or the return you'll actually get, is $2 or is $2.73. Add these two together is 30. If you had it for 2 years, you take this by 10%, and so on and so on and so on. $60,000 in 2 years is the equivalent of 49.59 thousand in time 0. 50,000 in 3 is equivalent to 37. 100,000 in year 4 is equivalent to 68. So they become smaller and smaller. The value of a future dollar becomes smaller and smaller today. And we simply add up. These are the future cash flows. This is the investment. And we add them up to get 6273. So the present value of this particular investment is $62,730. So it is positive. If you didn't have any other investments to make, if this was the only one you had, you would do it because it is returning something positive to you. It's worth taking the risk on. If you wanted to use a different method, which is the baked in formula in Excel, equals NPV, select the rate, select those future cash flows, gives you 182.73, we still have the same investment and we still end up with 62.73. So again, it's still relatively easy to calculate, but before going on, there's a couple of things that are worth just mentioning with all of this, which are these numbers right here. This is going to be a relatively known figure, the 120. You may well have it absolute or maybe pretty close to, knowing what that investment amount is going to be, but that is relatively objective, that number. It is relatively known. How much you're going to be able to receive for selling it down the track is likely subjective and is based on estimation. What your net operating cash flows are going to be, what you think you're going to bring in over the life of the project, again, is an estimation. So there's a risk there that these cash flows aren't what you expected. And the discount rate you're using is generally going to be a company or an organizational based discount rate. And that again is subject to change. If we change it to 8%, project looks even better. If we change it to 15%, project's still viable, but the net present value drops. So the discount rate does have quite a dramatic effect on the net present value calculated. And so do the choices made here. So there are a lot of assumptions built into these investments, and that makes sense because we're talking about something which is going to happen in the future, and none of us know the future with certainty. I mean, if we did, I can pretty much bet that you wouldn't be sitting here listening to this right now. Nor maybe would I be sitting here recording this right now. But we don't know the future with any certainty, so we have to make assumptions about it. So the advantages of the net present value method for doing things is it includes all the expected cash flows, it does include the time value of money, and does focus only on cash flows. In terms of disadvantages, it does rely on the use of an appropriate discount factor, and that's not always easy to figure out what that is. What the actual return is doesn't give you an idea of how big the return is on the outlay. That then you need to look at what the outlay is and sort of get a sense of it. So the actual, having a $1 positive NPV still means that it's worthwhile doing, but it doesn't give you a sense of the magnitude of the benefit. And there are going to be times when the highest NPV may not necessarily lead to optimum outcomes. So you may want to look at the timing of the cash flows when they happen, the risk behind them. So again, not necessarily the size of the NPV, which is important here. There may be more to it. So in summary, investment decisions do involve large amounts of money over long periods of time, and that does lead to risk and uncertainty. The accounting rate of return and the payback period are fairly quick. The NPV method takes into account the time value of money, and there are also qualitative factors that need to be considered.